Carvana stock is up over 130x. Not 130%, 130 times in the last few years. This is the biggest stock being talked about right now. Even last night in a group chat, a friend of mine started talking about Carvana stock. I had no idea what happened. It got added to the S&P. Guys, look at this chart. Look at this freaking chart. This stock got to a high of 344, got to a low of, I see 355 right here, roughly 355, and it's now back up to $453 per share. So, is it worth that? Well, what most people see when they look at a stock is they see this. They see a stock going up and up and up and say, oh my God, I got to get in on this train. What you're doing as a principle-driven investor that's watching this channel is asking the question of, is it worth it here? Guys, I'm not going to lie to you. I looked at the company was down here. I didn't see it. Why? It was a cluster F over here. They were losing money. They had tons of debt. This is the miracle situation. This is not something that happens normally. I don't want everybody thinking, oh, you buy a stock. We have Palantir. You bought it at $5, went up to $200. You buy Carvana at $3.50. It goes to $4.50. You make 130 times your money, whatever that number is. Guys, that doesn't happen. This was a turnaround, a massive turnaround. Let me show you what I mean here. Just to get started, let's look at the income statement here. Now, we look at the income statement to see revenue and profit, obviously. $18.3 billion in revenue last year. Look at this. 2020 to 2021, look at this growth. $5.6 billion to $12.8 billion to 13.6 down to 10.7. This was the heyday of the used car market, right? Remember, if you bought a car in 2018, you could have sold it for more in 2022. That was the heyday. But look at this. Losses. They didn't start making money until 2 years ago, 2023. That's the first year they'd made money. Okay, so that's tough. Let's look at this. The gross profit. Gross profit is every unit they sell, what percentage of that is profit? Goes to the bottom line before taxes and overhead. Go back to 2019. They did $4 billion in revenue, and they had $500 million in profit. That's 1/8. That's 12.5% gross profit, okay? That means every car they sold, 12.5% of that was gross profit. Well, look at it today. $18.27 billion in revenue, $4 billion in profit. What's that? 21%, roughly? So double 4 on 18, something like that. It's around 21 or 22%. That's a big difference, guys. They almost doubled their profit per car. Now, 21 years ago, I worked in the auto industry. I worked at a dealership in Toledo called Yark Automotive. I loved my boss there. He's still a good friend of mine. He runs dealerships for a large auto group. Back then, this was 21 years ago, you make money, well, even now, you make money in 2 ways in the car business. Front end, back end. Front end is, we bought the car for 10, we put 500 into it, we sell it for 12.5, we made $2,000 in profit on that 12.5. So $2,000 in profit. That's the idea behind it. Back end is financing the car, extended warranties, gap protection, back in the day, life and credit, life and disability, things like that, the extra products. Banks would pay these dealerships to use their loans. So for example, I remember back in the day, JP Morgan Chase had a 2% fee. So no matter what the person did, 2% of the amount financed was a fee. So if the customer financed $20,000, the car dealership got $400. Then we'd sell warranties. So you sell a warranty for $500 or $1,000 in profit, etc. All in all, that's what Carvana is doing here with their profit. And that's included in that gross margin there. Okay? Oh yeah, right there. Gross margin, 21.4%. So that means if they sell a car for $20,000, they're making 21% on that. That's $4,200. Okay, not bad. But here's the deal, guys. They made much more than that. Let me show you exactly how much they made because I want to show you guys. I just Googled it. How many cars did Carvana sell in 2024? 416,000 cars. Okay, so we go back here, go to income statement. 2024, they made $2.88 billion in profit on, call it 400,000 cars. Okay, let's do the math real quick. Boom, 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 boom. So then you have 28,800 divided by 4, call it $7,000 a car. Guys, that's good. That's really good. $7,000 per car in profit. So I messaged a friend of mine who works at a big dealership. I said, hey, what do you make on front end and back end of cars? He said, listen, we do pretty well on used cars, and we make, and his number was not 7,000, it was lower than that. So maybe you wonder, why is Carvana's number better? Well, could it be user experience? Absolutely. Why? Guys, every single person I've heard who's bought from Carvana said it's the easiest experience ever. They absolutely love it. Guess what? I love it. I've never bought from Carvana, but I've looked on Carvana, and I love the idea of this is the price. Do you want it or not? Yes, great. It'll be go to this location, they'll pick it up, blah, 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 you're done. That's the way car buying should be. I don't like the whole back and forth negotiating. Just put your price, and every so often, I will buy a car. I won't buy a car, and it'll send me a message. Hey, we just lowered the price of this car by $1,000. We just lowered it. But you guys got to remember, selling the car itself isn't the real big profit center. It's that back end financing. When they finance somebody on Carvana.com and get them, they take the pool of mortgages, and not mortgages, auto loans, and sell them off to somebody else. That's how they generate their profit. There have been accusations of the car company misleading investors on their numbers, having kind of spy numbers. I don't know, but I will say this. I haven't looked into that, but I will say this. Their free cash flow is not much lower than their net income. So it makes me feel better, because usually if it's a big discrepancy, it's easier to say that. And their free cash flow here in the last 5 years was much lower than their net income. They have big plans. Carvana has said they want to sell 3 million cars a year in the next 5 or 6 years or something like that. Guys, overall in this country, do you know how many cars we sell, how many used cars are sold per year? Well, I'll tell you right now, 35 million to 40 million per year. Carvana wants to sell 3 million of that. That's roughly 7.5% to 8.3%. That's a big number. Those are very ambitious plans. Now the question becomes, if they're able to do that, what's the company worth? Well, that's the problem we have, guys. As a principle-driven investor, you're looking at this saying, this is a company valued at $67 billion with actually little debt, $71 billion. There's a $5 billion difference there. It's still high relative to their cash flow, but they're within striking distance. But guys, car sales are cyclical. There's problems with that. Right now, we might be coming off of a less than stellar consumer buyer's market out there. Is it going to hurt things? I don't know. I haven't done as much research as I should on Carvana. See how long do they have inventory for? How does it work? Like, how are their financials? Is that 21% gross margin is really solid. Really, really solid for a car sales. But look at this. 3.4% bottom line margin, not the best. Now, AutoNation, which sells used cars and new cars, look at their gross profit, 17.8. But I'd want to understand that as a split between used cars and new cars, because Carvana is used cars right now. But I'm looking at this, and Carvana is the darling of the internet right now. It's up so much. It's entering the S&P. This is incredible. This is a company that's supposed to go bankrupt. Now it's entering the S&P. Guys, it's selling for 122 times free cash flow on a $67 billion company. Even if their business tripled tomorrow and everything tripled, it's still selling for 40 times free cash flow. I'm wondering to myself, are people just doing too much with this company right now and the stock price is getting out of hand? It feels that way. Look at it this way. Price to sales ratio of 3.66. Let's go to AutoNation. AutoNation's price to sales ratio, 0.3. This is Carvana's 12 times bigger than AutoNation. PE, 12.5. They didn't have free cash flow last year, but the 5-year PE, price to free cash flow, is 15. AutoNation, which is owned by a lot of big shots like Bill Gates and things like that, seems like the better buy here. Seems like the better buy. I'm looking at this saying, is the juice worth the squeeze? Let's see what analysts think about this. Well, $5 per share estimated this year in profit, growing to $11.39. That's solid growth, over double in the next 5 years. With revenue, $20 billion growing to $74 billion. Now, this $74 billion is an outlier. I mean, look at how much the jump is, 55% in the next 4 or 5 years. Carvana's got to spend a lot of money doing that. They have those towers. They have to get locations. But I got to think it's a very seamless process. From what I understand from people, and by the way, in the comments below, let me know if you've bought a car from Carvana, what your experience was like. Because I've literally never heard anyone say anything bad about the buying experience at Carvana. Not once. Not one time. That's incredible to me. So guys, we have some story. We have some numbers. Let's pull up our stock analyzer tool. Now, for those of you who are new to the channel, this is the tool I use to start out my investigation in a company. We have thousands of people in our community. This thing is used over 1 million times per year. The reason being is it's a great starting point. Should I spend more time on this company? So I'm doing actually, let's do a 10-year analysis here. I'm doing 7, 12, and 20% revenue growth. This 20% revenue growth would get them to over 3 million units per year. So I'm putting that in there. And I'm still putting in a lot of location growth and revenue growth as prices become more expensive. Profit margin, I did 3, 4, and 5. Same thing with free cash flow. Now keep in mind, 4 and 5 are above any number they have here. But I'm going to give them the fact that, hey, their gross margin's good. As they grow, this should get better. Now, what's the PE I should put on this company 10 years from now? Well, guys, I put 15, 18, and 21 because the return on capital is getting better and they're becoming a better company with lower debt, which I like. So I'm applying a 15, 18, and 21 PE. And then finally, what's my desired return? 9%. Guys, there's more to this video. I'm going to break down another great company that's outperformed the market for the last 5 years and it's under the radar. So make sure you watch this after I'm done hitting the analyze button. So we have the 9% return. This is just to find out what is my intrinsic value. What's the company worth to me if I were to match the market? Not what I'd pay for it, because I need to have margin of safety. I hit the analyze button. The stock is currently at $4.55 per share. This is why I'm apprehensive. Low price of 77, even on the high price of everything, highest free cash flow numbers, highest growth levels, everything, I'm at $4.37 per share and 170 in the middle. I have a negative return based on my middle assumptions. And guys, I also want to look at one more thing. I also don't like this. Look at these shares outstanding. 15.2, 30, 47, 65, 82, 100, 109, 122, 140 million. They are diluting the hell out of investors. This stock analyzer was not factoring in the dilution of shares. So it's likely making this even lower if they keep diluting shareholders. That's the issue. And guess what? I don't blame them. Their stock is sky high. Go issue shares like crazy. High demand company. It's entering the S&P. All these funds have to now buy Carvana. Issue the hell out of shares. Get the cash in your pocket. Let those guys deal with it. That's not the company you want to invest in, but I don't blame them for doing that. This is why I'm staying away from Carvana. When it was $3 a share, it was hard to see the turnaround. I'm not a turnaround guy in that one. In real estate, I am, not in these kind of businesses. But if this company survives, at some point in the future, they will sell for a value price. I will be ready to look at it then. Let's look up another company that is hiding underneath everybody. O'Reilly Automotive, guys. This company has outperformed the market significantly. Look at this chart. This is a 5-year chart. Chugga, 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 chugga. Now, price to free cash flow, 51. PE, 32. Why? Big difference in last year's net income versus free cash flow, 2.5 billion versus 1.5. Big difference, but their 5-year net income and 5-year free cash flow is spot on. So I'm not worried about that. That's probably some aberration. You know what I love? No dividend. These guys are sitting there saying, here's the big key and why O'Reilly works. Let me show you this, why it's been outperforming. Let's look at the income statement. Since 2020, revenue is up from 13.3 billion to 17.5. So what is that percentage? 4 on 13, call it 30%. Where's their profit? 2.16 billion to 2.5. Not much growth. Why? Guys, let me show you this. Carvana is diluting shareholders. Look at O'Reilly's doing. 1.22, 1.15, 1.11, 1.03, 965, 907, 875, 848. They're cannibalizing. They're buying their shares back. Keep in mind, buying your shares back is not a guaranteed winner if you're paying too expensive a price. it might be destroying shareholder value. But I want to show you guys something very interesting. This is O'Reilly's PE ratio since 2000. You sit here and go, all right, 20, 25. It's basically been a channel between, I would call this, what's the price here? Probably 15 on the low side to 30. Basically has been that channel. Now, this alone doesn't say it's cheap or not. Feels a little frothy, but guess what, guys? Let me show you something about O'Reilly that I love. Look at their return on capital. Their 10-year returns on capital are 47, 5 years 62, 1 year is 50. This means that when they invest money in their business, they get really high returns. They're on an aggressive plan to open more stores. They currently have like 6,700 stores in the U.S., Mexico, and Puerto Rico. And Canada, U.S., Mexico, Puerto Rico, and Canada now. And their goal, they opened, I think, 200 stores net last year. That's about 3%. So if you grow 3% in store growth and you're growing revenue at last year's same-store sales growth was 5.2%. That's a huge number for same-store sales growth. You're looking at 7 to 8% growth on revenue of the company. That's pretty solid. When you're able to do that, combine that with buying back inexpensive shares that they get inexpensive, you're able to give a lot of shareholder value just by being a ho-hum company that grows like this. That's all you need, because if you pay a great price for a non-sexy business, you can make a fuckload of money. And that's what we're here to do. We're not here to chase hype. O'Reilly is not hype. This is not hype at all. Look at this thing. Is this hype? This is not hype. This is slow and steady wins the race. That's what this is. Slow and steady wins the race. It was 15 cents per share back in 1993. Wow. When I graduated college, what was it at? I graduated in April of 03. It was $1 per share. I could have made, if I just go back in time and go to myself and go, Paul, put $1 million. Go raise the money, go raise $1 million from people, put $1 million in O'Reilly. It'd be $95 million right now. That's incredible. Why? And look at this. Here's the best part. Back in 03, if the stock is up 95x and the current revenue is $17.5 billion, it would be around $200 million back in 03. Look at this, $1.5 billion. It's 11x bigger. What about their profit? It's 25x bigger, 24x bigger, but the stock is up 95. Yes, the stock is probably a little overpriced, but they keep buying back their shares. That's what's incredible. By the way, is it overpriced? Because look at the current PE. 32, yeah, it's overpriced a little bit, but it's not overpriced by double. So I look at this saying, this is the kind of company where maybe every time it goes below a certain level of PE, you go on, because they are good capital allocators. So let's go to our stock. Let's see our analyst estimates first. Look at this. 338, 374, 393, 430, 504. Just consistent growth on earnings per share. Let's go to revenue growth. 6.5%, 7, 6, 5, 4.9, 10.3. Slow and steady growth. Slow and steady growth. So let's go to Stock Analyzer. Let's pull up O'Reilly. I'm going to do 3, 6, and 9% revenue growth in the next 20 years. I'm going to go back down to 10, though. Let's go to 10. Now, profit margin. As you can tell, they're pretty consistent between free cash flow and profit margin. So I'm going to stick with 14, 14.5, and 15. PE. What's the PE 10 years from now? Again, growing returns on capital, 17, 20, and 23, and a desired return of 9%. Now, before I go, I want two things, guys. This software is a game changer. It'll help you make better decisions. The community will help you make better decisions. When times are tough, you need to be in a place with like-minded people who are going to help you get through it. Because successful investing isn't about the numbers. It's about the emotional aspect coupled with the numbers. So if you're sick of getting upset every time a stock falls or you're missing on a stock going up, this is the place for you. Go check it out. We have a great trial. We have limited spots every day. We have a great 7-day trial. Join, and you'll see why 83% of people who sign up for the trial end up signing up for the year. So go do that, the link below. It's really, really important. Now, I hit the analyze button. Boop. The stock's currently at $94 a share. All right, I have a low price of 47, high price of 100, middle price about 70. All right, not bad. Should it be a higher PE? Maybe. Great company, buying back shares. So it's within striking distance. So if you're the kind of person who wants to, let me look at the options chain to see what it looks like for a month from now. So let's say you like it at $95 a share, for example, but you want a little bit of discount. Sell a $90 put. Sell a $90 put for January 16th. If it hits 90 or below, you collect $1.22 either way. You get a 13% return on the cash, and you pay a lower price than today. So you bought a company you liked at a lower price and got paid for that along the way. How wonderful is that? So guys, thank you very much for your time. I appreciate it, and check out the community if you're ready to up your investing game. Take care.